Hello, this is Professor Reynolds again, and we're going to be talking about Chapter 9, Evaluating Variances from Standard Cost. What this chapter allows you to do is basically, if you're in a manufacturing environment, it allows you to zero in on what the actual reasons for either better or worse cost. And it allows you to focus, instead of just saying, well, we're over budget, under budget by this amount, it allows you to talk about, well, is it because we paid more for materials? Is it because we used more or less materials? Is it because we paid more for direct labor or we used more or less direct labor? And the same thing applies for factory overhead, et cetera. Now, I'm only going to really talk about the first variance as far as materials, because once you learn that part, it really is the same thing for direct labor and for overhead. So manufacturers come up with standards. In other words, I'm going to make a car. I know how much all of these parts should cost. I've done studies, and I know that how long it should take, how much labor it should take to put an engine in a car, to put steering wheels in a car, to put tires on a car, to put the seats on a car, etc. And I'm going to use that as my standard. And then I'm going to allocate overhead based on whatever method that I'm using so that I know how much a car should cost me. And that's how I'm going to record that cost. But I'm also going to record the actual cost, and then I'm going to review the actual cost to see whether it met my standards. Now, over time, labor costs increase. Over time, parts may increase. But right now, I'm going to say, okay, I've done these studies again, and I know it should take on average this many hours and this many parts, etc. And then I'm going to use this to, again, refine and determine if I'm off, and if so, why. So you have standards for direct materials, direct labor, factory overhead. And again, it's how much a product should cost, and then how much it does cost. So again, a joint effort. You have accountants, engineers, management personnel. You have uh, purchasing managers, and they go out in the market and they source materials, and they have a pretty good idea on what it costs for tires and what it costs for batteries and etc. What it costs for steel, all of these. And so they will come up and determine, okay, here's how much the parts should cost. And then you have engineers, and they go over and look and review and come up with how much it takes to make a car. So the production manager is responsible for that. The production manager is also responsible for, the amount of overhead they're going to need. And again, this is all based on setting a certain production budget. Ideal or theoretical standards are standards that can be achieved only under perfect operating conditions. Normal standards, called currently attainable standards, are the standards that can be attained with reasonable effort. Such standards, which are used by most companies, allow for normal production difficulties and mistakes. When reasonable standards are used, employees focus more on cost and are more likely to put forth their best efforts. They use an example here of par. Now, I am a golfer. I sort of slacked off the last couple of years as far as the amount of golf that I've played. But golf has a standard called a par. So basically, a golfer that has a certain skill level should get a 4 on this hole, a 3 on this hole, a 5 on that hole. If you get better than that, it's called a birdie or an eagle, and you exceeded the standard. Most golfers are worse. They get 1 over, which is a bogey, and 2 over is a double bogey. So that is a standard. So as a golfer, you can compare yourself based on the score on each particular hole. Standard costs should be periodically reviewed to ensure that they reflect current operating conditions. And so over time, you'll notice again that maybe parts increase or decrease, or you're more efficient in labor, etc. Criticism here is that they limit operating improvements by discouraging improvement beyond that standard. So an employee would say, well, I've got the standards, that's good enough. They're too difficult to maintain in dynamic manufacturing environment, resulting in stale standards. They cause employees to lose sight of the larger objectives, and they cause employees to unduly focus on their own operations instead of taking the whole into account. But regardless, these standards are used widely. So if you're ever in a manufacturing environment, this is something that of which you need to be aware. So you have a standard price and your standard quantity. And so if you have direct materials, direct labor, or factory overhead, you're going to have a standard cost per unit, which is equal to the standard price times the standard quantity. So if you have 4 hours of labor and your labor rate is $20 plus $5 in benefits, so that's $25. So your standard is 4 times 25 or $100. So if you have more or less of $100 in labor, that is going to either exceed your standard or be under the standard. So here you have, again, standard price is $5 per square yard. You expect to use 1.5 square yards, and that's $7.50. You have $9 per hour. You expect to use 80% of an hour, so that's 7.2. And factory overhead, you're going to apply by factory by direct labor, so that's 6 hours. Again, 0.8, so that's 480. So the standard should be $19.50. If you're more than that, then that exceeds the standards, and you need to find out. If you're less, then that's better than standard, and you still need to find out. The standard price and standard quantity are separated for each product cost. For example, XL jeans, the standard price for direct materials is $5, etc. Okay, so then you look to see what actually happened, and you have favorable cost variance, which means that your actual costs are less than your standard cost. An unfavorable cost variance is the opposite. It means that it costs you more than what your standard was. And then if you're a supervisor, it's going to be your responsibility for determining what that is, but you're going to have assistance from the accounting staff, and they're going to give you information. To illustrate, assume that Western Writer produced the following pair of jeans. Okay, so they produced 5,000 pair of jeans. Direct materials was 40,150. Direct labor was 38,500. Factory overhead assigned was 22,400. And you can see here that direct materials actual cost were 40,150. Standard cost times at actual volume. So again, as it says here, you might have thought you were only going to produce 4,500, but you actually produced 5,000. So you have to compare the standard on what was actually produced. Now here it says that favorable is a negative number, unfavorable is a positive. A lot of companies use the opposite. A negative number means whether it's revenue, whether it's cost, a negative number means you have an unfavorable budget variance. A positive number means you have a favorable budget variance. So it's one thing to keep in mind when you're looking at numbers to make sure you understand what you're looking at. But in this case, positive means unfavorable. So we exceeded the standard by $2,650. And so we want to jump in here and find out why. We also exceeded the direct labor of 2,500, but we have a favorable factory overhead. So we are going to get into the old weeds here. And you can see here the total manufacturing cost can be broken down into different components. And then we can break it down even further. Did the material cost us more or less than what we budgeted? Did we use more or less than what we budgeted? And so that is what we're going to look at. So the actual direct material cost is equal actual price times actual quantity. The standard is the standard price times the standard quantity, and then the direct materials is the price difference plus the quantity difference. Okay, so direct materials cost variance is direct materials price variance, direct materials quantity variance. Okay, same thing with labor. So again, we're only going to look at the materials because if you can understand this, then this is just simply applying the math to the direct labor. So here we look again, actual cost is 40,150. We should have only spent 37,500. So actual price times actual quantity. So it was 550 per square yard times 7,300 square yards to get to 40,150. Now we're going to do math here, but you can just look and eyeball it and determine that there is a difference, and mainly it is the cost per unit. The actual price was 550 per square yard. Our standard was $5. So part of this, the majority of this, was because we spent 50 cents more per yard than what we budgeted. However, on the other side, we use less. So our actual quantity was 7,300 square yards. We thought we would budget 7,500 square yards. So this was over by a certain amount. This was under, and together that accounted for the difference of 26.50. And you can see here that the price per square yard was a difference of 50 cents. Quantity used was a favorable variance of 200 less square yards. Okay, so we could look to see that the materials variance was 36.50 unfavorable. So that's 50 cents times the amount that we used, 7,300. So that was an unfavorable variance of 3,650. And the quantity variance, though, was a positive amount. And we can see here that we used 200 square yards less times the standard quantity. We've already accounted for the additional 50 cents. So we're really only looking at, well, at the standard price, what is the difference? And that's a favorable variance of 1,000. So the favorable variance of 1,000 and the unfavorable variance of 3650 gives us a variance of 2650. So now you have something to talk about. If you're the manufacturing supervisor, you go, well, we use less material, but we paid more. So what could cause that combination? And that's really what you're looking for. Maybe we had to pay more, but we had better material. So we had less waste. So all in all, we spent a little more, we used less, but it's still an unfavorable variance. So you have to decide, well, is that what we need to do going forward, or do we need to go back and use the material that we had before? It could be that you had more skilled labor, and so they used less material, but you still had to pay more because that's just what the market is these days. And so when you start looking at these, you're going to do the same thing for direct labor, and you're going to look at, well, did we use more direct labor? And you're going to look at all of them together. So, for instance, let's say that the direct labor quantity was also favorable, and that would again imply that you have more skilled employees. And those more skilled employees then use less material. So it all kind of ties together, and you really have to look at all of the different components. Now, one thing you need to take into account is that if you use less direct labor, you're going to have less manufacturing overhead because how do you allocate manufacturing overhead? Well, by labor hours. So the manufacturing overhead variance is really due to the amount of direct labor and may not actually be a reflection of lower overhead. So that is something that you have to take into consideration. And really, that is the point of all of this, is that you have to look at all of the components here. You have to determine, well, did the material, did the labor cost more? Did I use more or less of the material, more or less of the labor? And what are the things that could cause that? Maybe you had more material because of machine malfunction. And that is something you can again address and go, well, we had a machine that was malfunctioning. We fixed the machine. So we had a one-time variance, but we fixed that. So going on, that should be improved. And that is what people are looking for. They're looking for answers. As you as a manager need to go into this meeting and have your ammunition. Be able to go, this is why we were favorable or unfavorable. And even if you're favorable, they want to know, is this something that we can continue? Is this something that we can change and go, well, our costs now are going to be lower going forward because we found better efficiencies. We've hired more people. They cost more, but we use less. So all in all, that is favorable. Again, this is the critical thinking here. So same thing here. Actual costs were more, but again, you look at the labor rate was higher. Um, this is the standard, but you use less labor. And so this would sort of tie in again. Well, maybe we used less material because we had more efficient labor. So, really, that's the majority of this chapter. You need to understand the math. It's not that complicated. And you can really kind of eyeball it to go, well, what did I pay per hour of labor? And what was my standard? And that'll give you an idea of whether you're, what that part is. And then how many hours did I use compared to how many hours that I thought I would use? This is a really good exercise. This is very valuable if you ever go into the manufacturing operation. You can also use it for service. If you have plumbers that go out and you expect them to be able to fix a garbage disposal in X amount, then you can look and go, well, how come it's taking more to fix this garbage disposal? And maybe you just need to train these plumbers better so that they're more efficient, and that would be an investment that hopefully would pay off over time. So get to know this chapter well. If you know one component like material, then you should be able to do the other components.